We all want to make more money. From the richest man in the world to the lowest wage earner, increasing our bank account balance is the one objective we all share as modern humans. Only a small fraction of us, however, get to achieve the financial independence we desire. We all want to be wealthy enough to never have to worry about money again, but only a select few actually reach that stage. But how do they get there? Luck? Privilege? Systematic favoritism? Or perhaps something as simple as information? Regardless of what you think and feel, one thing that we can all agree on is that financially independent people have something the rest of us simply do not possess. For decades, the means of attaining financial freedom and independence was known only to a select few. Luckily, with the advent of the internet, times have changed. Today, more people than ever before are reaching financial independence. You too can become one of them with good financial education and planning, as well as making it a priority to enhance your finances. How can you do this? Just what is the difference anyways between financial confidence and independence? And just what is the essence of learning about these things? In this video, we're going to answer these questions in depth. Stick around to learn more. Financial education refers to the set of skills and knowledge that enables a person to make informed and effective financial decisions with all of their assets. It's also known as financial literacy, and it's critical if you want to advance and succeed in life. What is financial confidence anyway? Financial confidence is the ability to recover all of your assets if you were to lose them all at once. True financial security entails being unconstrained by your work, country, or material things. Because no one can take away your skills and abilities, you get financial confidence. Number 1. The difference between an asset and a liability. Many people believe they understand what constitutes an asset. For example, you may believe that your home is an asset, but it is not. The truth is that there are two meanings of an asset, just as there are two definitions of a person. Accountants utilize a single definition that necessitates numerous financial exercises to make people and organizations appear wealthier than they are. This keeps them employed while keeping their clients in the dark. A different meaning, based on simplicity and truth, is used by the wealthy. Anything that puts money in your pocket is an asset, whereas anything that takes money out of your pocket is a liability. Because it takes money out of your pocket each month, your house is not an asset. Even if you own your home outright, you will still be responsible for paying taxes, maintenance, and other costs. This is why it's easy to understand how the middle classes struggle to buy a home has made them poorer, not richer, even as housing prices have surpassed their earnings. If you own a rental property, on the other hand, it might be an asset if it generates cash flow for you each month. Your tenant covers your mortgage, upkeep, taxes, and other expenses when they pay rent. This would explain why the rich, the top 10%, can increase their debt but exponentially increase their assets. They use debt to buy assets that create more wealth. Number 2. Cash flow versus capital gains. The majority of people invest to make money. The wealthy invest to generate cash flow. Simply put, capital gains investment is akin to gambling. You put your money in and wait for the price to rise. Many people, for example, purchase a home in the hopes of eventually selling it for a higher profit. Meanwhile, they must pay their mortgage and other living expenditures. Money is taken from their pockets. It turns into a liability. The problem is that you have no way of influencing whether the price goes up or down when you invest in capital gains. And the bigger one is that if you do make a profit, you pay the highest tax rate. The wealthy, on the other hand, invest for cash flow. So, for example, they might use other people's money to acquire investment real estate. Then they find tenants to pay the bills and collect rent each month. It turns into a benefit. It's also a plus if there are capital gains. The wealthy have control over their income and pay the lowest tax rates, and often none at all, by investing for cash flow rather than capital gains. Number 3. Using debt to get richer. Debt is bad, according to your financial advisor. The wealthy, on the other hand, recognize that debt may be leveraged to generate enormous wealth. There are two types of debt: bad debt and good debt. When your financial advisor advises you to avoid debt, she means avoid bad debt. Obtaining money for liabilities like buying TVs and vacations on credit cards, borrowing a line of credit on your personal property, and more can lead to bad debt. Staying out of bad debt is sound advice, but your financial advisor isn't going to educate you about good debt. Debt used to purchase assets such as rental property is considered good debt. When you utilize bank money to buy cash-flowing real estate, you use less of your own money to acquire an asset since you simply pay a down payment instead of the entire amount. And your tenant's rent pays off your loan while you own the asset and the profit. Steps to achieving financial freedom. Financial independence is not something that will happen by chance. Discipline and commitment, as well as a series of specified steps, will be required to make this ambition a reality. These steps can help you achieve financial freedom and prevent costly financial blunders. They'll also put you on the right track to making early retirement a reality. 1. Define your financial freedom. When you ask most individuals what they want, they will respond, financial freedom. But what exactly does that imply? As earlier stated, financial freedom means the ability to live by the earnings of one's assets. Even then, there's a lot of room for interpretation, as financial freedom can mean different things to different people. Does it simply imply a frugal or opulent way of life? Do you prefer to live in a high-cost or a low-cost area? Will you have to pay a mortgage or rent? Or will you be able to live in a home that has already been paid off? What, if any, additional debts will you still have to pay off? All of these choices will affect your concept of financial independence. 2. Make a financial plan. Making a budget is one approach to guarantee you stay on track with your financial goals. Every dollar of money is given a purpose in this way. Budgeting for that morning cappuccino or a trip to Hawaii, for example, can be challenging at first. However, if you've gotten into the habit of living within your means, your budget can be liberating. All of the money that enters your account is considered income. Every dollar of money must be put to a certain use, an expense, taxes and charitable donations, as well as irregular payments such as the car insurance bill due every 6 months and non-essentials such as dining out are all considered costs. Each expense is accounted for in the budget. Then you should separate your costs into needs and wants. One method of allocating money suggests devoting 50% to needs, 30% to wants, and 20% to savings. If your spending surpasses your income, you'll have to figure out how to satisfy your needs on less money or to find new sources of revenue to make your budget work. However, once you've written out your income and expenses, you'll have a better idea of what you need to do to regain control of your finances and avoid costly mistakes. 3. Create the correct accounts. To achieve financial independence, families require more than just checking and savings accounts. Additional account types have become crucial to success because they allow you to build your money tax-free. A 401k or an individual retirement account, for example, is where the retirement money should be kept. Are you putting money down for your child's college education? This will necessitate the creation of a separate account for your 529 plan. Emergency money, such as non-retirement savings, may need the creation of a separate account. 4. Make a plan to pay down your debts. The United Nations has identified a global phenomenon known as debt bondage. Others may use different terminology, but debt is the polar opposite of financial freedom. As a result, paying off debt or avoiding it entirely is an important aspect of becoming debt-free. Debt repayment necessitates a well-thought-out plan. According to studies, families frequently use the balance matching heuristic. This entails paying off all debts at the same time, which might result in customers spending more in interest and paying off debts more slowly, if at all. The avalanche approach has been suggested by several. This entails allocating all extra debt payments to the debt with the highest interest rate, hence lowering the amount of interest paid. Other experts advocate the snowball technique, which allocates all monies beyond the monthly minimums to the smallest debt to motivate debtors as debts are paid off. Regardless of whether you prefer the avalanche or snowball method, it appears that attacking debts one at a time is the most productive strategy. 5. Put money aside for an emergency. Rachel Cruz, a personal finance author, suggests saving $1,000 for an emergency fund, regardless of debt levels. She recommends fully funding the account after you've paid off all non-mortgage bills so it can cover 3 to 6 months of costs. Why? Cruz said in a DaveRamsey.com piece, "You never know what's going to happen." Most of these unexpected occurrences can be financially prepared for with an emergency fund. Cruz also suggests keeping your emergency savings in a separate account. Keep the money close enough to pay a doctor or a mechanic fast, but not so close that you'll be tempted to spend it excessively. 6. Improve your financial education and financial literacy. Unfortunately, the majority of people finish their formal education without ever taking a personal finance course. This constraint might make you your own worst enemy when it comes to achieving financial success. Saving, budgeting, debt avoidance and repayment, taking advantage of tax-deferred accounts, and investing are all essential skills for financial success in today's society. Seminars, reputable articles, and podcasts can teach you ideas that will help you achieve financial independence sooner. 7. Make an investment. If you don't learn to make money while sleeping, Warren Buffett once said, you'll work until you die. One option to gain money while you're sleeping is to invest. Depending on the sorts of accounts you have, you may use different investing tactics. Diversified mutual funds and exchange-traded funds containing bonds or a basket of stable, large-cap stocks or other assets may be required for your retirement plan. You can set aside a little sum for higher risk, but potentially more rewarding investments if you have some spare cash and a risk appetite. Even so, keep the majority of your capital in diversified, lower-risk investments. And don't be afraid to get competent guidance from a financial professional who can help you assess your risk tolerance and analyze potential investments. Bottom line, learning how to obtain financial independence and doing it are two completely different things. Those who desire to study can take advantage of a range of resources, including books and classes, as well as a variety of internet tools. But in the end, it is up to you and your resolve to succeed. Making good financial habits a part of your daily routine requires dedication. If you stick with this plan long enough, you'll not only have less debt and greater savings, but you'll also be able to apply these stages using money made while you sleep. Hey, you've made it to the end of this video. So what do you think? Which of the financial literacy tips do you find most insightful? Let us know in the comments section. If you enjoyed the video, make sure you drop a like and subscribe. Oh, and turn on post notifications. Now, if you'll excuse me, thank you for watching. I'll see you in the next video.